Hello, I'm Bryce Knorr, Senior Editor of Farm Futures Magazine. Welcome to The Buzz for Thursday, July 26, 2012. Market analyst Arlen Suderman joins me from Wichita to discuss the latest twists and turns of the historic drought market of 2012. Corn and soybean prices raced to new all-time highs last Friday, but the euphoria didn't last long. The bullish mood eroded quickly at the start of the week on forecasts for rains both this week and into August. Amounts so far have been pretty disappointing, keeping price action volatile. The official drought monitor released by the government this morning showed the drought intensifying as more extreme heat baked the Midwest. But forecasts call for that heat to retreat a little bit back towards your part of the country, Arlen, giving much of Iowa, Illinois, and the northern and eastern corn belts some relief. What do you think of the outlook, Arlen? Should I be breaking out my umbrella here in the central Midwest?
I think a lot of people would be happy to get wet without an umbrella if they could just get a good rain and get it soon before it's too late. It's been an interesting summer as we've looked at the forecast. There are two major weather models, the American GFS and the European model. The GFS has tended to be too cool in its outlooks, the European too hot compared to actual conditions in recent days. But the European model has been closer to the mark on temperatures. As when you look at precipitation, the GFS models continue to perform better in forecasting rainfall totals, but has been a bit too generous with the coverage, while the European model has done well on placement of rain showers, but has understated the anticipated totals by quite a bit. However, forecasters have tended to lean a little bit more again toward the European overall. But the bottom line is we get the systems moving across, we get scattered storms, but we have not seen a pattern change. It's difficult to turn around a drought, and when the air is so dry, the soils are so dry, you don't get that evaporation to put moisture back in the air. It's just very difficult to match rain gauge totals with what the radar shows. And so we continue to deteriorate with another bout of heat coming in, particularly over the southwestern half of the Midwest as we get into next week.
Corn prices, at least for December delivery, showed the most resilience, battling back from limit-down losses on Tuesday to maintain their steep uptrending channel off June lows. But September lost most of its big premium to the D's, with more signs of eroding demand. Both old and new crop sales out this morning showed net reductions, reflecting export basis at the Gulf that's down some 45 cents from early June highs. Ethanol production was lower for the sixth straight week as well. Still, this has only reduced demand maybe 50 to 100 million bushels, barely a scratch if new crop production is 4 billion bushels lower than original estimates, as my model now shows possible. Indeed, forecast models suggest prices could go higher still unless the crop is much bigger than the 10.8 billion bushels I currently project. Arlen, do you think the corn market still has legs, and what should farmers be doing in this uncertain environment?
Well, the bottom line is I believe that supply is falling faster than demand, so I believe the market has more work to do. Now, bringing supply and demand into balance means that prices must be high enough for a long enough period of time in order to curtail demand to bring it into line with the newfound supply. Now, that can mean a spike to very high prices, or it can mean a sustained level at not as high a price, but at a sustained high enough level to wear down the demand sector to where they give up and either reduce demand or shut down. And so that's the big question, is what it would be. I feel more confident with soybeans than I do at corn at this point, but I still believe that this corn market has new highs ahead of it, because I do not believe that the market has fully factored in the scope of the losses in this year's crop. Couple things I'm looking at. First of all, harvested acres. USDA currently at 88.9, fourth highest percentage on record at 92.2% of planted acres. If we look back to the drought of 1988, which our crop condition index scores now drop just barely below, essentially matching, we harvested 85.5% of planted acres. Very similar number in the 83 drought. So that gives us a benchmark. That would be about 82.4 million acres, or about 6.5 million acres less than USDA is currently saying. So even if you go with a 4 to 5 million acres, you still got a lot of loss of bushels there, although that'll slow the rate of decline in the actual yield since we get rid of those lowest bushel yields. The other thing is aflatoxin. Anticipating under stressful conditions that there would be a good deal of the crop that won't be saleable anywhere. It may have to simply be destroyed. So when you put that all together, we could very easily be looking at a net crop of 10 billion bushels, or perhaps even lower in a worst case scenario. It really depends on how the northwestern Midwest finishes out. If you look at the days ahead, where the Northwest still has the most potential to recover yield loss, that's where it's going to be the driest. So that's a real concern. But that's 4.7 billion bushels less than USDA anticipated, as you mentioned earlier. That's 3 billion bushels worth of rationing. I don't think we've done that yet, and so I think we have more work to do. Strategies, crop insurance covers you up above $11 with the doubling of the guarantee rate of $5.68. You could look at, if you think we are possibly going $10-11 on a spike, look at buying those call options at those strike prices right now. You get $11 for 5 or 6 cents on this price break. Get a $10 for like 13 cents. Which is small change in this market where we're changing that much in a matter of a minute or two. And that gives you the freedom on a price spike to go ahead and do some selling. And perhaps as we get that high, also purchasing some put options, particularly out of the money put options, will give you a lot of protection on the collapse lower.
Soybeans saw the most volatile swings this week, trading in a range of more than $1.50 a bushel. Funds appeared to be liquidating some of their big net long position amid the belief that rain the next couple of weeks would keep production losses in check. Still, demand remains red hot. China keeps buying old crop beans, meal is on fire, and old crop carryout could be more than 30 million bushels lower than USDA projects. Rain could increase production more than the 2.7 billion bushels suggested by current crop rating, but it still looks like a lot of rationing is needed. What do you think, Arlen? Is the rally over in beans, or will higher prices be needed to tame that demand?
Yeah, like I said, the job of the marketplace is to bring supply and demand into balance. We have a reduced supply, regardless of any rains we have from this point. I don't think we're going to recover all of our production. When you look at the demand, I think it's very realistic to be looking at a 500 million bushel reduction below what the supply is. And so we do have demand rationing to do. But yet, when you look at the crush numbers to this point, because of the drop in ethanol production, lower DDGs available for protein and rations, and higher demand for soy meal, we're not rationing on the domestic side. On the export side, both new and old crop soybean export sales at seasonally strong pace. So we're not rationing even at $17 soybeans. This market has more to do. It's just unbelievable how inelastic this market has been. And so that's where I feel most confident. The crop insurance revenue guarantee for those bushels that are covered, that portion of crop that is covered, 2 times the spring guarantee level, that takes you up to about $25. If you look at call options at that level, so I'm not forecasting prices up there, but I do think we need to go probably above $20. But if you look at those $24, $25 call options, you can get them for pennies, or you can get something a little bit lower for a little bit more, give you some protection for doing some flat pricing on the rally once you're comfortable how many bushels you'll have to sell. And of course, looking at your revenue crop insurance levels. And that's where you could also start looking at those out-of-the-money put options, because there probably will eventually be somewhat of a collapse. If I was looking at, particularly if I was looking at some selling some put options, I would look at the deferred months in the deep into money type of situation, because I expect a big increase in soybean acres in South America. But for now, I think we've got some opportunities for some higher prices.
Wheat continues to be the market's weak sister or little brother, take your pick. Futures at all 3 exchanges broke support lines from the rally, with spring wheat production here in the U.S. looking good. The market's uncertainty focused on competitors, especially the former Soviet Union. Production will be down out of the Black Sea, and there was talk of a sales ban from Russia at some point. Traders are also getting more concerned about dry conditions for winter wheat seeding, especially on the plains. Arlen, what's the outlook out there, and do you think there's anything to those Russian rumors?
Well, that's the big million-dollar question on the Russia ban. I personally remain skeptical. I think Russia took a big hit on the international market in 2010 with its embargo, and it doesn't want to do it again. But it will do so if it feels like higher food prices are going to create such social unrest, and that is a legitimate risk for it. So as we go forward, it's said to have been this week actively buying Chicago and Minneapolis wheat futures. That tends to make people wonder, are they going to institute a ban? What do they know? What's going on there? There could be various reasons for that. But that is creating headlines now and giving some support to wheat. And so while I remain skeptical, there is actually chatter if Russia does so, Ukraine may as well, and that would significantly reduce feed wheat availability at a time when the world is running short on corn as well. So that has huge implications going forward. And then we go into 2013. Right now, the global wheat supply is at about a 97-day supply. The big rally that we got to record highs in 2008 came on about 75-day supply. So we're well above that, but that was a modern-day record. However, if we significantly increase global wheat feeding more than is currently expected, and if El Nino creates a short crop in Argentina and Australia, which is a possibility, then we could start dropping down to snug levels, but I think still adequate. But can we rebuild stocks in 2013? We certainly can with these prices. Will stimulate probably a desire to expand acreage. But as we look to the northern hemisphere, the biggest opportunity to do that is in the U.S. plains, where drought has claimed a lot of the summer crops. If the rains fall this fall, we'll see a lot of wheat acres go in and then see what it looks like in the spring, whether to keep it or not. If the rains don't fall, then we're going to have some problems in a short 2013 crop as well. That's when things get explosive. It's going to be feast or famine in 2013 on the wheat market.
For the first time since the weather market erupted, influence from outside markets was felt at times in the grain trade this week. First, fears of a global economic slowdown helped defuse the rally on Monday. Later in the week, hopes that governments and central banks will finally get their arms around the crisis seemed to encourage risk-taking, weakening the dollar and providing some support to commodities. Arlen, the European debt crisis seems to be a long-running soap opera without end. Is there any reason to believe the latest hopes are different? And does the ability of Wall Street to hurt prices on LaSalle Street signal the bull market in grains is finished?
I do not think that the European debt issue is over. I believe that it will get worse before it gets better. We will continue to have this bungee cord effect back and forth of emotions. I do think that this week provides a great example of how it can pull the rug out from underneath of the bull market in grains. But I do not believe that it will keep the grain market from doing the job before it. I just think it'll be a rough ride with big price swings, more of what we've seen in recent days.
Thanks, Arlen. We'll be back on Friday, August 3rd with results of our exclusive Farm Futures Crop Report survey. Until then, catch up on all the latest developments with our daily video at www.datelinedrought.com.